Do you want to master ICT Power of Three strategy like a pro to level up your trading? ICT Power of Three is the strategy which exposes the smart money traps for retail traders. As we all know, as a retail traders, we are trading against the smart and informed money, and they tend to manipulate the market moves to trap the retail traders. In this video, we will be exploring the ICT Power of Three strategy to avoid these traps and follow the footprints of smart money. But to be able to use the ICT Power of Three strategy, one must have a correct daily bias. Once you have got the correct daily bias, you can use ICT Power of Three strategy to catch a good move in the market. The ICT Power of Three trading concept aims to expose the tricks and methods used by the smart money to retail traders. This way, retail traders are able to time their entries and avoid taking trades when and where they're likely to lose. Now let's start with defining the ICT Power of Three strategy. The ICT Power of Three is rooted in the understanding that large institutions and smart money, who have the resources and information to move prices to their advantage, often manipulate the markets. These entities use the accumulation and manipulation phases to build and disguise their positions before the real move happens during the distribution phase. And retail traders, who often rely on conventional indicators and strategies, are frequently caught off guard during the manipulation phase, causing them to lose trades. The ICT Power of Three is also heavily influenced by market psychology. The accumulation phase preys on traders' impatience. The manipulation phase exploits their emotions, and the distribution phase rewards those who understand the game. This cycle mirrors the broader psychological journey of market participants, making it a powerful tool for those who can grasp it. The word ICT Power of Three is basically derived from three main concepts: accumulation, 2, manipulation, 3, distribution. ICT Power of Three concept is also known as AMD setup because of the three main concepts: accumulation, manipulation, and distribution. Now let's understand, what does it mean by accumulation, manipulation, and distribution? Accumulation phase is when the day opens, market ranges near opening price, and smart money accumulate their positions in this area. The accumulation phase is the first of the three stages in the ICT Power of Three concept, where the market shows signs of consolidation or accumulation. During this phase, large institutional traders and smart money participants begin building their positions in a particular asset. These entities are not yet ready to move the market significantly, but are quietly accumulating assets without causing noticeable price shifts. If you can accurately identify this phase, you're better positioned to anticipate the market's next move: manipulation. Manipulation phase, as obvious from the name, is to manipulate the retail traders. After accumulation, smart money moves the market in opposite direction, like on bearish day, they manipulate the retailers toward buy side. And on bullish day, they manipulate toward sell side. They do this by running price above or below the accumulation phase. The manipulation phase is the second stage in the ICT Power of Three concept, where the market appears to break out of its accumulation range, but does so deceptively. During this phase, the market will trap retail traders into trades in the wrong direction, then target their stop loss, creating false signals that lead to premature entries and exits. This phase is characterized by sharp, often sudden movements that seem to confirm a new trend. But in reality, they're designed to shake out weak hands before the real move occurs. Distribution phase is the real move of the day. After manipulating retail traders, smart money add their positions toward the real direction of market, hence moving market opposite to retail mindset. The distribution phase is the final stage in the ICT Power of Three concept, where the market moves decisively in the intended direction after the manipulation has shaken out weak hands. This phase is characterized by a clear trend, either bullish or bearish, as the smart money participants begin to distribute their positions for profit. Unlike the previous phases, the distribution phase typically exhibits strong momentum and is where the most significant price action occurs. On a bullish day, prices accumulate near the opening price of the day. As we discussed earlier, smart money accumulates there by positions in this area, and after that they manipulate retail traders by a sharp sell, move below open price, engineering the liquidity and targeting any old low. Retail traders mark this manipulation move as breakout toward downside, and they try to sell the asset. On the other hand, those retail traders who bought in the accumulation get their sell stops activated below the old lows, so neutralizing their buy positions. Now smart and informed money buy the asset in discount area below its opening price and push the price upside in distributing move targeting old highs as a liquidity, leaving a wick below opening price. After clearing the old highs liquidity and forming the high of the day, smart money sell their positions to close their buys, and market moves back to the daily range, leaving a wick above. It closes below the high of the day. On a bearish day, prices accumulate near the opening price of the day. As we discussed earlier, smart money accumulates their sell positions in this area, and after that they manipulate retail traders by a sharp bullish move above open price, engineering the liquidity and targeting any old highs. Retail traders mark this manipulation move as breakout toward upside, and they try to buy the asset. On the other hand, those retail traders who sold in the accumulation get there by stops activated above the old highs, so neutralizing their sell positions. Now smart and informed money sell the asset in premium area above its opening price and push the price downside in distributing move targeting old lows as a liquidity, leaving a wick above opening price. After clearing the old lows liquidity and forming the low of the day, smart money buy their positions to close their sells, and market moves back to the daily range, leaving a wick below. It closes above the low of the day. That was it for this part 1 of these videos about ICT Power of 3 strategy. See you in the next one.